monetary policy and what it is that we can do in relation to understanding that policy, because many times we are going to find through the mainstream media a lot of narrative that is really misinterpreting and generally misguiding the public when it comes to understanding what it is that the Federal Reserve is truly attempting to do with their interest rate setting policy. Now, it's important to go back into history to look at the Federal Reserve and what it was that they were saying over the previous 20 years about what it is that monetary policy is really meaning for the Federal Reserve. And excuse me one second here, guys, make sure the Wi-Fi is turned off there. So what the monetary policy really means for the Federal Reserve and how it is that the Federal Reserve is conducting their monetary policy, considering that we have a situation that is now taking place in which that the inflationary pressures that are building within the economy are now forcing the Federal Reserve to have to be in an elevated position in order to tamper down, to push down on the inflationary pressures. But at the same time, we have a lot of people who are saying we got a weakening labor market. The Federal Reserve has to support this weakening labor market by lowering interest rates, and this is going to benefit the general population out there and getting a job. And so this confusion that is now happening within the mainstream media narrative about what it is that the Federal Reserve is truly attempting to do makes it very confusing, but it does make for a lot of debate. So when we look at what it is that the Federal Reserve has been communicating about something called the neutral interest rate, and I know people roll their eyes when I say this, but it is a very important understanding of monetary policy to know what that neutral interest rate really means for the Federal Reserve. And now we hear something saying like from Jerome Powell in which that the neutral interest rate is now 100 basis points closer to the current Fed funds rate than it was a year ago. But then at the same time, we have like the new Fed official coming to the FOMC, the Federal Open Market Committee, this Myron, who is saying that the neutral interest rate is much closer to zero. Again, John Williams, who has been the New York Fed president for quite some time and very influential on the FOMC, had a speech recently saying that R star has not moved much since COVID or prior to COVID. And now this makes it very confusing. Like, what in the world are these guys talking about when it comes to R star, neutral interest rate, and their monetary policy, their interest rate setting position with the Fed funds rate? Now, I'm going to try and break this down again for you guys in the most simplest of manners, because when I heard stuff in the past coming from John Williams saying that if you have a downward push on inflation, that actually takes away from the monetary stimulus. And that seemed very odd to me, that a downward push on inflation would take away from the monetary stimulus. But once you start to understand R star and how it is that the inflationary expectation in relation to R star then puts the Federal Reserve in a position in which that they have to have a Fed funds rate that is elevated in order to maintain a neutral position. Now, again, I know that sounds like all spun around, but when you really look at this for the reality of it, it makes a whole lot of sense. Now, take the inflation out for just a minute. Just remove the inflationary scenario and imagine it as if it wasn't occurring. If the Federal Reserve had an economy or had a monetary policy operating within the economy that was maintaining low stable prices with full employment, what would that interest rate be? That's R star. Now, if you incorporate the inflation into it, now the Federal Reserve has to elevate the Fed funds rate in order to make up for the inflation scenario, which then would put the Fed funds rate at a much higher position up above the inflation in order to maintain a neutral position. So again, these are two different interest rates, but essentially kind of talking the same thing, one with and one without inflation. So this is the reason why you have people like Myron saying that there is a low neutral interest rate, along with John Williams saying R star hasn't moved much, because it really hasn't. It is now hovering slightly above zero, somewhere around 0.5%. Some people will say that it's up to 1.5%. There is no real way of telling exactly where the R star is. It's a complete assumption. There is ways of saying, where it's at over time. Like you can look back and say, okay, this is where it was at. But to see it in real time is very difficult, and it's also very difficult to pinpoint what exactly inflation is. Because we can say, hey, inflation is 2.5, 2.8 according to the Federal Reserve's official numbers, and then the reality of the situation is inflation is much different from that. But when we look at the Federal Reserve and their official inflation numbers, and we look at what it is that they are saying is R star, you put these two together, and that's where the Fed funds rate would need to be in order to be neutral. And somewhere around today, it's going to be, slightly over 3%. Again, there's no real way of telling exactly where this number is, but that is what the Federal Reserve is attempting to get to, is that neutral position. If the inflation expectation falls dramatically, then the Fed would have to drop their Fed funds rate in order to maintain neutral. They would have to essentially chase that inflation rate down. If the Federal Reserve was to stay still and the inflation expectation was to fall, this would begin to cause a very restrictive economy to take place. This is why inflation falling is not a good thing for the Federal Reserve and their monetary policy, because it restricts the economy when the inflation falls. If the inflation was to rise, then what would end up happening is that the Federal Reserve would be able to see more monetary stimulus coming out of the low interest rate environment, or at least the economy in general, as the inflation moving up would then make the economy far less restricted. Now, let's suppose, for an example, that the Fed funds rate was standing still and the inflation rate was standing still, but this hidden esoteric neutral interest rate called R star, if this was to happen to rise, Federal Reserve sitting still, inflation happens to be standing still, and R star begins to rise, this again would make the economy less restricted. Do you see how this is operating? This is why most people can't see what it is that the Federal Reserve is attempting to do. It's because of these three interest rates: R star, inflation, and the Fed funds rate, where those are at. And there's actually the fourth one, where the neutral interest rate would be for the Fed funds. Those are the four positions in which that most people should be looking at in order to understand monetary policy. Again, R star is the interest rate in which, or the Fed funds rate that would not be accommodating nor restricting the economy prior to the inflationary scenario. If you removed inflation, where would that interest rate be? Okay. That's the nominal Fed funds rate. The real Fed funds rate is when you incorporate the inflationary scenario to it, and now you have an elevated Fed funds rate. In order to be neutral, they would have to be much higher than the inflation rate and much higher than the R star rate itself, which, combining those two, would then put the Federal Reserve somewhere around the neutral position. Okay? So you got R star, you got inflation, then you got the Fed funds rate. That is a neutral position, and then you got where the Fed funds rate is, the effective fund rate. Whether or not that is above or below that neutral position is accommodating or restricting the economy. Does all that make sense? I should have had a whiteboard for this, but I think that probably clears it up, doesn't it? Once you see this, you'll begin to see how it is that the expectations coming from the markets themselves can either create a stimulating effect or a restricting effect, just simply by basing off of that inflation expectation. If you lower the inflation expectation, what you will do is raise the real interest rate. That will be very restrictive on the economy. If you raise the inflation expectation, you will lower the real interest rate, making the economy far more accommodating. And people wonder why it is that we have such a resilient economy. Elevated inflation expectation saves the day. It makes the real interest rate much less in the real economy. Does all that make sense? I don't know, guys. I'm trying to break this stuff down. I have to do it this way. If I do not break this stuff down for you guys, you're gonna miss it. You're gonna miss the neutral interest rate, the R star, and what it is that the Federal Reserve is truly attempting to do with the monetary policy in relation to an inflation expectation. When you combine all these together, it really starts to make a lot more sense on how it is that the Federal Reserve is conducting themselves. Most of the time, we're stuck on this idea that the Federal Reserve either accommodates or restricts the economy by moving the Fed funds rate. Nothing could be further from the truth. They can maintain or move that Fed funds rate, but then gain or lose monetary effectiveness by raising and lowering the inflation expectation. This is how the Federal Reserve is truly conducting themselves, is through that expectations. When you think about how it is that the Federal Reserve can talk about interest rate adjustments and have as much power as they do by talking about the interest rate adjustments, that would not exist if the Federal Reserve was at the lower bound of zero. The fact that they have elevated interest rates is the reason why they have an ability to even talk about it. They knew back in 2018 that in order to have this sort of policy where they can talk about interest rate adjustments, they would have to have inflation persistently too high rather than too low. If it was too low, they would be at the lower bound of zero, and talking about interest rate adjustments simply would not work. They would have no credibility there. They hardly have any credibility as it is, but most people will look at the Federal Reserve and the interest rate setting policy as the main policy tool, but it's the communication about it. And the only reason why they even have a communication about it is because of the elevated inflation and inflation expectation that has risen the neutral interest rate, which has the Federal Reserve in a position in which that they are attempting to try and combat that, which now gives them the ability to talk about it, which is by far the most important tool. All right. I don't know how many other people are going to see it that way. How far are we into this? 10 minutes into this video. And I can guarantee you there's probably less than, I bet you there's less than 10,000 people out there who know what I'm talking about. You know that? I don't think there's anybody in any kind of, anywhere. I don't think anybody anywhere knows anything about what I'm talking about right now, except for maybe central bankers and the economists who are incredibly ingrained into the monetary policy of the Federal Reserve. They would be the only, that would be it. Everybody else is talking about something far off that is not anywhere close to what it is that the Federal Reserve is looking at for monetary policy. The only way I was able to even come up with the things that I am saying is because this is what the Federal Reserve was communicating through their own words and speeches. Like, I didn't make this stuff up. This is their own words. I have combined, I've put together a combination of speeches and documents coming from the Federal Reserve that have proven this to be the case time and time again. This Reuters article is about the closest thing that I have seen so far that you know, that even describes what's coming close to the monetary policy. Most of the time you're going to find things that are so far off from reality that really, I almost believe that they are set there on purpose to literally deter the people from, you know, to guide the people down a misdirected road in order to keep their attention focused in on interest rate adjustment, so that they don't really see the reality of the situation. How many times have you seen out there the people talking about the K-shaped recovery or K-shaped economy, you know, recovery economy, however you want to look at it, and never really give any kind of consideration to what it is that Cantillon had described hundreds of years ago, right? Very, very few do I see ever take that into consideration. And to know that it was an underlying economic force that it was playing out, it makes it very easy to start recognizing the symptoms that people are then looking at as the causes, because you already know why it's happening. Cantillon described it as new money pouring into the system and people diving into luxuries. When it comes to understanding monetary policy from the Federal Reserve, they were in a position after the great financial crisis in which interest rate adjustments was no longer an effective tool. They knew that was going to be the case going into the future. Ben Bernanke described what it was that they were going to do in a speech back in 2002. long before the great financial, no, not long, 4 years, 5 years before the great financial crisis even took place, he says, hey, when the Fed funds rate gets to the lower bound of zero and there's no more interest rate adjustment policy that's going to be effective for stimulating the economy, we'll still have the ability to actually stimulate the economy. Let me tell you this story about a guy who invents a gold machine. And then he talks about this hypothetical gold machine that this guy can produce as much gold at will with very little cost or energy. And then once that information gets out to the public, widely publicized and scientifically, proven that he could do this, the price of gold would plummet. That right there, that little gold machine story, that is the monetary policy of the Federal Reserve now. Nobody knows that though. And I'm not sure why. I'm not sure why they didn't take that into consideration. It's not like they don't even came up with this whole idea called forward guidance when they actually tell people we are going to keep interest rates extra low, extra long for an extended period of time. When people take that into consideration, what it is that actually does for the economy, and now when you have the Federal Reserve essentially doing the same thing, but not in a forward guidance manner, but in a signaling manner, a credible threat manner, dropping little hints about what it is that they're going to do, and then in fact they have many Fed officials come out at the same time talking many different stories in order to create this diverse viewpoint that then has the people having no clue about what it is that's going to happen for monetary policy. They then have to then incorporate what it is that this communication means to them, and that communication to the people itself is the monetary policy. Like right now, how many people are convinced that there's going to be an interest rate cut but have no clue about after that? That's the policy. They convinced you of an interest rate cut. You've already priced that one in. There is very little doubt that that's not going to happen, this interest rate cut coming up at the next meeting, at this meeting coming up. Very little doubt that there won't be one. But after that, nobody really knows. And I can tell you right now that the R-star is probably not going to be too far from where it is today, which from the gathering of information out there is somewhere around 0.5%. And I can tell you that if the inflationary expectation doesn't change, then you can bet that there's probably going to be some position in which that the Federal Reserve is going to be slightly above what would assume be that neutral position. Because if inflation did rise, the last thing they want to do is reverse course and raise rates. So if they are maintaining slightly above that neutral position, the R star plus inflation, that's the direction in which that they want to be. This is what we are getting. This is what we see today. As many times as you're going to find all these excuses and reasons and thoughts and beliefs about what it is that the Federal Reserve is going to do, what I am describing is what the Federal Reserve has been describing. Yeah. I mean, I've put the speeches together. I've talked about them so many times that there is literally no other way that I can see this now, because of so many times have I read their words describing these events. Yeah. And we got a hell of a storm going today, man. We're supposed to get like 4 inches of rain. It's crazy. Alrighty. Are you saying the Fed is Rumpelstiltskin? Okay, interest rates cut and housing crash are both expected, even dangerously known. I'm going to borrow cheap money from my assets below 15 of the LTV and get more assets, more monies. Do you think junior minors is a good investment at this point with the upcoming interest rate hikes? Upcoming interest hikes. And also, is a possible small hyperinflation period? I doubt both of those. I don't think there's going to be interest rate hikes. Now, if the Federal Reserve was to sit still, think about it like this. If the Federal Reserve was to sit still with their Fed funds rate and the inflationary expectation began to fall and they didn't move, right? That would be essentially the same as an interest rate hike. If they sit still and say, hey, we're going to wait and see what happens, and inflation continues to rise, that's going to be very stimulating, or less, I shouldn't say stimulating, it should be very less restrictive, and if it rises enough, it could actually get into accommodating. So I would watch that position. how is it that the inflation and inflation expectation is going to be persistent going into the future? I mean, it's so funny to think like they have already lined up the next credible threat for inflationary scenario, right? Game two plan for when the tariffs are deemed illegal by the Supreme Court. And so, I mean, it was so funny because so many people had told me, dude, there's no way that the Supreme Court's going to shoot this down, right? And I'm thinking, well, they are setting up a game two plan. Like, that's not me setting up a game two plan. That's them setting up a game two plan. Like, I'm not trying to be convinced that the Supreme Court's going to shoot it down. They're convinced that the Supreme Court's going to shoot it down, or else they wouldn't be setting up a game two plan. They wouldn't even consider it. By even considering it, they are now establishing the credible threat. You see how this works? In order to keep, like, think about it, if they remove these tariffs, this is probably going to be the most amazing thing that I have ever, like, been able to call out. All right, but if they remove these damn tariffs and the Supreme Court deems them illegal, and then all these corporations sue with a protest or whatever it is to get these tariffs back, and that money is then actually handed back to these corporations. Think about it. They got their bonus with the inflationary pressure by raising the prices, and they get it back. All right? Now, there is a very real threat to this economy by bailing out corporations. That there is no better way to have a political hell to pay than to bail out corporations. When government steps up and says, oh man, sorry, we got to, offer up these golden parachutes to all these corporations and save the day, the people lose their mind. They hate it. They hate that idea, right? They cannot stand it. But what if it's already baked into the cake? What if it's already baked into the system? Sorry, these tariffs were deemed illegal and now this reimbursement has to take place. There's nothing we can do. And now the corporations who already basically made their money with the price hikes are now going to make a bonus off of this when the Supreme Court deems them illegal and they ask for the reimbursement. Now, I'm not saying that's going to play out, but I'm saying that's probably going to play out. All right? And only time will tell. Now, if that happens to be the case, there's a game two plan that they're already establishing that's going to keep the credible threat of tariffs, creating an inflationary pressure, continuing into the economy, which is exactly what the Federal Reserve needs in order to maintain elevated interest rates, in order to maintain the ability to communicate about it. Because that is the policy, the communication. And they can't have the communication if they don't have the credible threat of tariffs, or at least a credible threat of an inflationary pressure built by whatever. COVID, war, tariffs, whatever you want to throw at it. As long as there's a broken supply chain, then you will have the credible threat of inflation. And with the elevated inflation expectations, you will be able to raise that real interest rate. And that will give the Federal Reserve the ability to continue to communicate about it. All right. I've said this so many times. This is like, it's not hard for me to see it now. I don't blame politics. I don't look at like Jerome Powell being the key indicator of where it is that interest rate's going to go. That's about the lamest thing I've ever heard. Right. Jerome Powell is a spokesman for the FOMC. He has 1 vote out of 12. I don't know where it is that people say that he's going to change anything about anything that is happening at the Federal Reserve. That is the most ridiculous thing I have ever heard in my entire life. I've studied a lot of the Federal Reserve and the communications from the Federal Reserve, a lot of communications from the different FOMC, participants, and the belief that things will change at the FOMC when you change the chairman is very, very illogical. Like, that is not how it works. That's not how any of it works. Jerome Powell is a spokesman. He speaks on behalf of the FOMC. When he is speaking about monetary policy, he is speaking on behalf of all those participants. Right? When each one of those participants come out, they give their own opinion. They're not speaking on behalf of the FOMC. You see the difference inside of it? So yeah, you can have a different communicator out there, but he's still going to communicate what it is that the FOMC is talking about and thinking and doing, right? So you have to change everybody who sits in the FOMC. which is 12 voting members, 5 alternates, and 2 advisors. There's 19 people who make that thing up. And changing 1 or 2 of them doesn't change anything about the strategy. Okay? Understanding the strategy from the get-go. Knowing R-star, knowing the inflation, knowing that the Federal Reserve is slightly above that because maintaining a neutral position when inflation can adjust or R-star can adjust will put them in a position in which they may accidentally become accommodating. They do not want to do that, so they'll be slightly above it. That's what the Federal Reserve is doing going into the future. Unless something dramatic changes, like some kind of major event. I mean, unemployment skyrockets, some kind of war breaks out or something unforeseen, some black swan event takes place, which very well could, because they always do, things would change. But as far as right now, we got unemployment that is still historically low. We got a very resilient consumer out there, and now we know why, is because the economy is far less restricted than anybody knew or gave it consideration for. Knowing this to be the case going into the future, you know that the Federal Reserve is most likely not going to be in a position in which that they are going to be accommodating when they are trying to maintain neutral. If you have inflation that is adjusting up and down, then they are probably going to be slightly above that because they want to be in an inflation expectation that is persistently too high rather than too low. They do not want it too low. They want it too high. 172 people watching. I hope you're enjoying this, and I hope I'm not just completely confusing the hell out of everybody. All right, so the bottom 80% doesn't matter. Their statement doesn't matter. Yeah, I mean, essentially 80% of the people down are not necessarily the consumers in which that are going to be participating in the economy in any kind of profound way that can create the inflationary pressures that the Federal Reserve would typically be looking for. So now, understanding that the Federal Reserve used to lower interest rates that would create an environment in which that unemployment would fall. They would lower interest rates, corporations borrowing money, hiring people, that hiring people, lowering unemployment, all these people working, going out there and spending that money, increased aggregate demand, the consumption, supply demand imbalances were found, and this is where the inflationary pressures came from. So now when the Federal Reserve found that after the great financial crisis and their interest rates had hit the lower bound of zero and they had zero interest rate policy for like years and years and years, they found that the Phillips curve, the flattening of the Phillips curve, was essentially proving that low unemployment did not create an inflationary scenario. It broke. Their system broke. Lowering interest rates, corporations hiring people, going out there spending money, increase the inflation, failed. Failed. They were like, crap, now what? Now what do we do? This is very bad. How do we find the inflationary scenario if we cannot lower interest rates to the lower bound of zero and create an inflationary pressure on account of it? Now, the expectations of the people was quite elevated. I know I was one of them. I dumped all my money into silver and was screaming hyperinflation all through the great financial crisis. And when 2018 and 2019 rolled around and I was completely broken, wondering what it was that was going on within this economy, I started this YouTube channel and started breaking down monetary policy, and this is what I found. Right? This is what I found from it. They could not operate their monetary policy with the interest rate adjustments anymore. It didn't work. Their communications about it had a profound impact, and they used those communications more than anything else. Right? More than anything else. And this is how they do it. You can see it taking place right here, right now. I think this is much bigger than competency. They're systematically destroying the current system. They're not. The current system is self-destructing all on its own because that's the natural consequences of having ever-increasing amounts of new money that pours into the system, is it eventually is going to get too top-heavy. There is nothing that can stop the inevitable collapse when the new money turns off. And it's like, this is how it works. It's called the Cantillon effect. If it was gold, if it was digital, it doesn't matter what it is. If it's new money that constantly pours into the system, you will have people who have access to it diving into luxurious experiences that will then drive a separation between the rich and the poor. That inequality will then force the domestic manufacturers to go seek the cheaper manufacturers outside of the high expense, high standard of living of the ever increasing amounts of new money state. This is like, I mean, I can repeat it over and over again. There is very little doubt in my mind on how this is working. I mean, it's, a lot of people want to blame it or find the excuse or blame, and that's reasonable because they're like, if you don't know, then you're going to assume. And by assuming, you end up generally focusing to blame. They're to blame. They're the reasons they did this. Think about when they, did this law change. Think about how it is that they forced this sort of outcome to take place. And me, I look at that and say that all those things that you described would never had occurred if it wasn't for the fact that ever increasing amounts of new money came in and gave them the ability to now have a position to do that with. Like, it shouldn't exist to begin with. And people say, well, they forced that upon us. They didn't. We are choosing it. We are choosing to live this life. Not a single person here is required to use dollars. We choose to use dollars every single day. Every day I go into work, I'm promising to trade my hours for dollars. I'm promising to pay taxes in dollars. I am functioning in a dollar system, and I am voluntarily doing that. I don't like it. I want to complain about it, but complaining about something that I am not willing to change is not useful. So instead, what I am going to do is look at this system and try to figure out what it is that I need to do to best position myself in accordance to it, because it doesn't matter what I like. Doesn't matter what I like or don't like or think is fair or unfair, and none of that stuff matters to me anymore. What matters to me is that I know that there is a way to look at this, deal with it in a way that I can then incorporate it into my existence that then benefits me. Most people incorporate it into their existence so it hurts them because that's what they believe it's doing. If you believe it, you are right. You are absolutely right, man. I mean, I cannot argue with you. You are right, man. This thing is going to absolutely destroy you, especially if you research for it. If you research how it is, it's going to destroy you. Research nothing but New World Order, conspiracy theory, mind control concepts of the global governance and all the other stuff that goes with it. I guarantee you it will deteriorate your life and send you into a pit of despair. All right, guarantee. All right, the only stay dollars for like a couple of weeks tops. Giving me dollars is like giving me assets with a fee. The influence is real, but the choice is ours. That's right. All right, you can't manifest everything. Reality is reality. Yes, I disagree. I absolutely disagree. I disagree wholeheartedly. You can absolutely manifest anything into your life because I have. Right? I have. I mean, I don't know, ask for something far beyond possibilities like going to the moon or something like that. Then yeah, you're probably going to be a very far stretch from being able to do that. But I pulled myself out of a position in which that I thought that there was never going to be like any way. Do you realize, like, before I even started this channel, that I had this idea that I would really like to be able to get on stage, share my thoughts and ideas with the crowd of people out there, like an audience of people. I thought, man, it would be so awesome to be able to meet guys like Ron Paul. And then one day it happened. One day it actually happened. I'm on stage and I'm speaking to the same audience as Ron Paul is going to about ready to speak on to later on the day. Right? I'm sitting at Hell's Kitchen in Las Vegas having lunch with G. Edward Griffin, the guy who wrote a book that absolutely changed the course of my life. And I'm sitting here having lunch with the guy who's asking me about the lumber industry. He's asking me, dude, what happened? Why did lumber take off? Why is it doing the things that it's doing? Right? Another guy, I was thinking, man, all these people who I had dreamed of meeting someday, I got to meet them all. Right? I thought of that long before I ever had a YouTube channel, before I ever even thought about doing any kind of economics, before the Uneducated Economist. I thought about all that stuff. If you can't think you can do it, then guarantee you ain't going to do it. But if you think you can, you will. It's just a matter of time. If you put yourself in the mindset that, man, I would really like to do that one day, I guarantee you the universe will begin to line up so it just absolutely happens for you. Do you think that if I had tried to meet G. Edward Griffin and have lunch and, at Hell's Kitchen with them and talking about, economics and lumber industry, if I had tried to do that, you know how difficult it would have been? But I didn't have to try to do it. The universe lined it up for me. All I had to do was just think about it and go out there and do the job that I'm doing. Be out to be helpful, useful, and have that in my mindset, and the rest of the world will just line up and just hand it over. But if you don't believe it, then it won't come. I guarantee you it won't come. You have to believe it. If you don't, it won't. If you do, it will. Think about all the things that you happen to have that you have manifested into your life that most people say, man, that's amazing that you were able to do that. And you think, oh, it was no big deal, right? It's because you truly believe it. Deep down inside, you knew it. Not having to be convinced, not thinking, oh man, or whatever, I'm lucky. You just knew deep down inside. And that's it. That's all you need. What DP you think will be happening with gold and silver in the future? What do you think will be happening with gold and silver in the future? Well, that's a very difficult thing to answer because of the amount of manipulation that happens within that particular market. So, I mean, if you're asking what's going to happen with silver, I mean, anything can happen with silver. I mean, it could go up, down, sideways. I couldn't tell you. However, the need for a precious metals within an individual's portfolio, within their actual holdings, and I'm talking about the physical, is almost a necessity in this sort of like day and age when it comes to this economy. There is no other way of getting out of a third-party risk or a claim than to be within silver and gold. And like there's literally nothing else. Some people might be able to find the same kind of value within, like, say, ammunition or food or something like that. But really, when it comes to tradition of 5,000 years of storing value for any kind of length of time, there's nothing more than silver and gold, and those two are essentially it. So when looking at it in this way, I think it's absolutely critical that you have this particular insurance policy. If you have expectations of it going up like this huge astronomical amount so that you can trade it off for some other kind of value like houses or things, I don't know. Like, to me, I don't try to look at it that way, and if that was the case, I would probably be moving into miners or some other kind of like something else that would probably move quicker and easier to liquidate than, say, just an insane amount of silver. I'm not saying that would be hard to liquidate, but it's just much easier to, use a stock broker or something like that to make a move in that sort of nature. So for me, like, I look at precious metals as an insurance policy, and I don't really think about them any other way. And that's it. That's it for them. But the chances of them going up in the future are probably quite extreme, considering, the things that are taking place. And the more, like, hate for the dollar that exists, even during, like, general safe haven moves, like when you have war breakout or some kind of critical issue, a lot of times you will find people, like, moving into U.S. treasuries, moving into the dollar. Well, that may not be the case anymore because of all the issues that we now have with the dollar. That only leaves really gold. I mean, Bitcoin to a lesser extent, but it really only leaves gold and silver, the precious metals, in order to, find a safe haven asset to be in. If that is the case, most likely during a downturn, you're going to find the dollar and the gold rise together, which is something that you wouldn't typically see, but from now on, that's the way I believe it's going to happen. Protecting yourself, like using it to protect yourself during an economic downturn, I think is very risky, because most of the time, if you end up using it to, like, try and buy food, you're probably just going to end up unloading it right away for an incredibly, like, ridiculously low price, because you're desperate, and when you're desperate, you'll pay any price. However, being able to carry that precious metals over to the other side. So if you have like doomsday scenario, complete economic collapse or something like that, you got to figure out a way to survive without using your silver until you get to the other side of whatever economic hell that's paying, and hopefully still be around and have it in order to meet that growth period where things start to turn around and start doing better, because that's what you want to invest in, right? That's the moment that you want to start deploying your silver into order to get the gain. But if you're just using it for like, you know, a utility for survival, then you're most likely going to lose it pretty quickly. You know. What time is it? Ah, gee whiz, guys, I got to get going. But you guys are awesome. Thank you so much for being here. We have 174 people watching with 58 thumbs up. I know the beginning of the video talking about the R star, the neutral interest rate, the inflation rate, where it is that the Federal Reserve is trying to position that effective fund rate in relation, all that stuff can get very, very confusing very fast. But I really know that if you can internalize that particular bit of information, you are going to have so much understanding over literally 90% of what most people are talking about when it comes to the Federal Reserve and their interest rate setting policies. Understanding that R star, I'm going to explain it one more time quickly before I go. Understanding that R star has not moved very much since prior to COVID, which means that it is somewhere around 0.5%. You can't see this in real time. They have estimates of it, and this is somewhere around where it's supposed to be, is somewhere around 0.5%. Again, there's different models saying different things. If we assume it at 0.5%, and we have an inflationary scenario that is running, let's just throw another assumption out there, at 2.5%. It's running hotter than the Federal Reserve is wanting it to. If you combine these two together, it would put the Federal Reserve somewhere around 3% on their Fed funds rate in order to be neutral. They are going to be slightly above that, right, in order to be restrictive if you have an inflationary scenario that is running persistently above the target. So this is the reason why their Fed funds rate are probably not going to be dropping too much more into the future, because they are getting close to neutral as it is. Now that neutral interest rate, again, is not R star. It's R star plus the inflationary scenario, and where it is that the effective fund rate needs to be positioned in order to deal with that elevated inflation, that 2.5%. If that comes down to 2, be a different story. Fed funds rate would have to come down. But looking at the Fed funds rate or the monetary policy in that particular light is going to be by far the most accurate way. Okay? That's it. Uneducated economist. You guys let me know.